Good morning. Come to question number 26. Format is ready. First, we'll write in this consolidated SOFP. First, start with property, plant, and equipment. Parent company, write 6500. Subsidiary company 2750. But there are two adjustments also. If you see question number 24, 3000 rupees was carrying amount and 3300 rupees was fair value. So by 300 rupees, the value will increase. And there is a depreciation adjustment. 20 years is the useful life of this building. Method of depreciation is straight line. Estimated residual value is 0. So on 300 we have to provide depreciation. Take 300 divided by 20. Is it 1515? That is depreciation. Depreciation. So tell me 6500 plus 2750 plus 300 minus 15. 9535. Second effect of this 1500 will go in that fair value adjustment, goodwill working, and this 15 depreciation will go in P&L account. Okay. Next line. Investment in Orange County Limited. This you write in calculation of goodwill. Consideration paid 4500. And what was the NCI in the previous question? NCI opening balance. Question number 25. Is it 1175? And what was the total? Total 5675. And fair value of identifiable net asset was how much? 4700. And goodwill was how much? Keep it up to this. We'll come back. So this covers your share capital, pre-acquisition profit, and fair value adjustments. Do not transfer goodwill to SOFP because there is an adjustment there. Next line, current asset inventory. Inventory, write down in the main page. Opening inventory, parent company is how much? Subsidiary company 550. Do you need to make adjustment for increase in opening inventory that has been sold? So that will adjust in the profit and loss. So how much is this? 1350. Trade receivable 380 plus 300 680. Cash and cash equivalent 4170 plus 1420 is how much? 5590. Share capital, parent right here 5000. Then you parent also write in SOCIE 5000. NCI, how much opening balance was there? 1175. And retained earning opening balance, how much will you write? Go to question number 25. 10,000? Was it 10,200? Right. This is, I think, in question number 25, right? Question 25, opening. Okay, now current year retained earning we will calculate. Subsidiary company, 2,000 share capital has gone in this calculation. See, 4,700 includes 2,000, and this also includes pre-acquisition profit also. So total profit now it is appearing is 2850. Total profit is 2850. So right here in working note 1 P&L account, pre-acquisition was how much? 2,300. You will find in question number 24, and now it is 2850. So you put 550 here, and then we'll do some adjustments. So is it matching 2850? Yes. Then we have trade payable. Come back to SOFP. Trade payable 350 plus 170, 520, 350 plus 170 is 520. Then come to SOPL, sales. Do we have any intercompany sales and purchase? No. Is the subsidiary acquired for 1 year full, 12 months? Yes. So we'll just add these two numbers. 3,000 plus 1,900. How much? 4,900. Very good. Cost of sale will have an adjustment. 1,800 plus 1,000. Go to question number 24. Inventory figure was increased by 100. Inventory figure is increased by 100. So that means the opening stock will increase by 100. So cost of goods sold will increase by 100. And it has been sold. So no effect in the closing stock. How much is the total? 2,900. Wait. Administrative expenses, 400 is given plus 350. And it includes depreciation of subsidiary. How much? 250. So 3,000 was the opening balance, and now it is 250, 2750. So depreciation of subsidiary I can identify, but depreciation of parent I cannot identify. Some students said, go to last year. Last year parent's property plant equipment was 7,000. Now it is 6,500. So depreciation is 500. That is your suggestion, but the total administration expense itself is 400 given. So we don't know. I can't say minus something. Okay. So otherwise administration expense will become minus something. So ignore. And this depreciation 250 you write here. Just remove it from here and write here. So how much is administration expense? 400 plus 350 minus 250, 500. We just want to show it separately because We have opened a heading. 250. An amortization of goodwill. In how many years goodwill will be amortized? 10 years. So you can assume impairment instead of amortization. So how much goodwill we had calculated, do you remember? 970, 975. This 250 plus additional depreciation 15 plus this additional depreciation on increase in value 15 and minus 97.5. This is goodwill impairment. Plus, sorry, all figures are plus. So what is the total now? 362.5. The second effect of this is over here. Amortization of goodwill we have to deduct, and depreciation 15 we have adjusted in PPE. So now you can go to property, plant, equipment, goodwill, right? 975 minus 97.5. And G, how much? 877.50. Seems to be right. Okay. So we are in the profit and loss account right now. Up to administration expenses we have discussed. Next paragraph. We'll just see if anything is pending. Blue Heavens Limited is unable to make a reliable estimate of the useful life of goodwill, and consequently the useful life is presumed to be 10 years. That we have done. Blue Heavens Limited uses the straight line amortization method for goodwill. The fair value adjustment to building and other PPE is in respect of a building. All buildings have an estimated life of 20 years. Estimated residual value is 0. Depreciation method is SLM. Done. All the inventory held by Orange County Limited on 31st March was sold during the year. So now what you do? Find out the profit before tax. First take total of these three items. Total B. How much is total B? 3762.50. Profit attributable to NCI parent afterwards. Tell me profit before tax only. 1137.5. Okay, we'll come to this by preparing analysis of profit. So now we'll have to come to this format. Analysis of profit. Profit and loss account we have done. Okay. Then in the pre-acquisition we had done fair value adjustment also. 3 items we had written here. Go to question number 24. One was property, plant, equipment, 300. Inventory, 100. 2 items we have written. Now this 300 you have written. The side effect of this 300 is additional depreciation. Additional depreciation 15. 300 divided by 20 years. And then sale of opening stock. Resulting into decline in profit This 100 will now come here. Okay. It was sold in this year. So this year profit will get reduced. What about this goodwill impairment? Should I write that also? No. NCI is based on proportionate share in net asset. So NCI will not share the impairment of goodwill. Okay, so don't write. If you write it, it will get allocated to NCI also. Total pre-acquisition 2700, post-acquisition 435. Pre-acquisition, this 2700 is included in this 4700. Post we have to allocate. Post write down Blue Heavens Limited 75%. Okay. How much is Blue Heavens share in post? 75%. 3 and how much? 326.25. And what is NCI share? 108.75. 108.75. So this 108.75 you write here in NCI 108.75, and this you also write in profit and loss 108.75. So parent share will be total minus this. Balancing figure is parent share. How much you are getting for parent? Right here 1028.75. $1028.75 right here also. Okay. Now you complete the lines first. 5,000 plus 10,200 plus 1175. Total 16,000. How much? 375. 1028.75 plus 108.75. 1137.5. Very good. Take total now. 5,000. This is how much? 10,200 plus 1028.75. 11,228.75. And this NCI is how much? Total 1283 point. Last column total. Last column in total 17512.5. So now you come to main page. Retained earning, write down 1128.75. 1128. How much was that? 11228. 11228.75. And how much is this one? NCI 12. Take total 18032.5. 180 32.5. Is it tallying? Write one note. Impairment of goodwill. Impairment of goodwill is not adjusted in. Impairment of goodwill is not adjusted in NCI because NCI is based on proportionate share in net asset. NCI is based on proportionate share in net assets. Second point, write down. Cost of sale will increase as the opening inventory value will increase. Cost of sale will increase as the opening inventory value will increase. Done. Come to the next wonderful question number 27. Question number 27. P Limited acquired 80% of the share capital of S Limited 2 years ago. When the reserve of S Limited stood at rupees 1,25,000. So what is 1,25,000? Opening reserve, pre-acquisition reserve. P Limited paid an initial cash consideration of rupees 1 million. So cash consideration 1 million has been paid. Additionally, P Limited issued 2 lakh shares with a nominal value of rupee 1 and a current market value of rupees 1.80. So we'll take fair value of the share issued 1.80 into 2 lakh. It was also agreed that P Limited would pay a further rupees 5 lakh in 3 years' time. This is called deferred consideration. 5 lakh will be paid but after 3 years. And this promise was made when? 2 years ago. So first we'll compute the present value and then we'll have to also add interest for 2 years. Not 3, 2 years. 2 years are over. Then current interest rates are 10% per annum. That is for one computing the present value of 5 lakh and also calculating the interest on the opening balance. Appropriate discount factor for rupee 1 receivable 3 years from now is 0.751. The shares and deferred consideration have not yet been recorded. Oh, the shares and deferred consideration have not been recorded. So what you will do? You will record now. So come to this working note in your answer sheet. Cost of investment, cash. How much cash was paid? Rupees in 1000. Cash paid is 1 million. So how do I write in rupees in 1000? 1000, sure. So write here 1000. Shares not recorded. Now we'll record. How many shares were issued? 200,000 multiplied by 1.8. 200 into 1.8. 360. And deferred consideration 500 into, they have given the factor 0.751. Use that. 375.5. So what is the total cost of investment? 1735.5. So we have to pass entry for these two items. This 1000 is already appearing in their SOFP if you see below in second line in the asset side. So what rectification of investment entry you will pass? Investment in S limited account debit. Total of these two figure is how much? 360 plus 375.50. 735.5. 2. Equity share capital. Equity share capital. How much? 200 into 1. Face value. 2 securities premium. 200 into 1.8. 200 into 0.8. 160. Right, 160. 160. And 2 deferred consideration. 2 deferred consideration. How much is that? 375.50. So this, remember, this effect of this entry is yet to be given in the SOFP. Now I'll read the problem further. Below are the SOFP of P&S Limited on 31st December 2014. Property, plant, equipment, investment tick mark. The total investment figure now will become 1735.50 for goodwill calculation. Then inventory, receivable cash, equity, share capital. Tick mark share capital also, because you have issued shares, so 200 rupees plus. And then retained earning, and one more item will come, securities premium in this problem. Next is retained earning, non-current liabilities, current liabilities. Further information. At acquisition, the fair value of S Limited plant exceeded its book value by 200,000. So tick mark plant, property plant, plus 200. The plant had a remaining useful life of 5 years at this date. So 200 divided by 5 into 2. Why into 2? 2 years are over. So the depreciation in the balance sheet that we need to provide, additional depreciation, 200 divided by 5 into 2. Okay. Keep writing the calculation. For many years, S Limited had been selling some of its product under the name M Limited. At the date of acquisition, the directors of P Limited valued this brand at rupees 250,000 with a remaining life of 10 years. The brand is not included in S Limited SOFP. So this new asset will come in the books, brand. First you will write 250, then amortization 250 divided by 10 into 2. Is it right? Increase in value will come in pre-acquisition period. Amortization and depreciation will come in the post-acquisition period. Next line. The consolidated goodwill has been impaired by rupees 280,000. P Limited Group values the NCI using the fair value method. So this time we will apportion impairment of goodwill to NCI also. At the date of acquisition, the fair value of the 20% NCI was 3,80,000. So that is the opening balance of NCI. Prepare the consolidated SOFP as at 31st December 2014. So ready, steady, go. First, let us start with property, plant, equipment. Have you understood the two adjustments? Right. So, property, plant, equipment, parent company write 5500, subsidiary write 1500, increase in value of plant 200, is 200, right? And how much is the depreciation? Is it 80? 200 divided by 5 into 2 years, 80. So what is the final figure? 7120. Second effect of these two items, 280, you come to SO, analysis of profit, and there you write, keep the first 2-3 lines blank, fair value adjustment, under that write PPE 200, keep 2 lines blank, then write down additional depreciation on PPE 200 divided by 5 into 2 years are over. So you said 80. Second effect is over. Come back to the SOFP. Right, next line. Investment in S Limited at cost. Now that figure will change. So how much is the consideration paid after adding shares issued and deferred consideration? 1735.5. Okay. 1735.5. Then next line. The second effect of that also we have to give. Issue of share. Issue of share, write down here. Issue of share. In the share capital line, issue of share 200. And securities premium column 160. And deferred consideration, there is a working note on deferred consideration also. Right here, working note for deferred consideration. First write down A, opening balance. Opening balance. How much was that amount? Right, 375.50. And then we have to make adjustment, but I'll do that later. First, let me finish the line by line items of balance sheet. Come back to current asset. Current asset is simple. No adjustment in the 3 items. So you give me only the total figure. Inventory 550 plus 100. Trade receivable 400 plus 200. 600. Cash and cash equivalent 250. Next, share capital. First you write share capital here now. Opening balance. This is opening balance given to you 2000. And retained earning, write 1400. And how much NCI was there on the date of acquisition? Last adjustment 380. 380. Second effect of this NCI opening balance in the calculation of goodwill 380. Total A plus B. 2115.50. Okay, keep it here. So this is your share capital of parent, retained earning of parent. What about share capital of subsidiary? 500 in the goodwill working note. 500. And retained earning of subsidiary. So you go to the starting few lines of the questions. What was the retained earning on the date of acquisition? Are you given 125 in the question somewhere? And balance sheet figure is 300. So post acquisition, they must have earned 175. 300 minus 125. Post acquisition earning is 175. So that 300 is also written. Non current liability, current liability. Come to SOFP, non current liability. Is there any adjustment there? No. Add 3000 plus 400. How much? 3400. Current liability. Add 1250 plus 650. Current liability add 1250 plus 650. Is it 1900? All items of SOFP are over. Okay. Okay. Now share capital, everything is done. Adjustment number 1. At the acquisition date, the fair value of S Limited plant had exceeded by 200. That we have done on the screen here. And the plant had a remaining useful life of 5 years. Done. Second effect also given. For many years, S had been selling some of its product under the brand name of M Limited. At the date of acquisition, the directors of P Limited valued this brand at rupees 2,50,000 with a remaining life of 10 years. The brand is not included in S Limited SOFP. So now two effects on the screen. Brand. What is its fair value? 250 minus amortization 250 divided by what is the life? 10. How many years are over? 2 years are over. 2 years. So what is the net amount in the outer column? 200. Second effect we will give in analysis of profit. Right here. In fair value adjustment brand 250. And then write down amortization of brand 50. Is 50 right? Okay. Point number 3. Consolidated goodwill has been impaired by 280,000. So go to that working note on goodwill. Less impairment 280. And the second effect of this 280 would be you allocate it to parent and NCI. So write down less goodwill impairment. What is their shareholding percentage? 80-20. In the ratio 80:20. How much is that? 224 point, 224, 56, 280. Point number 4, P Limited values the NCI using fair value method. Done. At the date of acquisition, NCI was 380,000. That also we have written. So now the closing ceremony will start. But before that, there is one adjustment which is pending. What is that? On deferred consideration, we have to calculate interest for 2 years. So write down in working note 4, point number B, add interest at the rate of 10%. Add interest at the rate of 10% on opening balance. So how much it comes to? Is it 37.55? Draw one line. Tell me the total of this. 413.05. Point number C, write down again, plus interest at the rate of 10% for second year, plus interest at the rate of 10% for the second year, 41.31. Make it 41.31. So point number D, write down balance at the end of second year. Tell me the total now, balance at the end of second year. 454.36. 454.36. So this you write in SOFP, and the interest you will write in SOCIE. Will reduce it from retained earnings. So come to this line, finance cost on deferred consideration. Total of the two interest, first interest was 37.55 and second interest was 41.31. So total is how much? So this you will reduce from retained earning. And then the closing balance of deferred consideration you write here in non-current current liabilities. Now only 1 year is remaining, so it has come under current liability. Okay. What was the last total? 400 how much? 454.36. Sure. Very good. All adjustments are over. All adjustments are over. Sure. Once you are sure, then what we'll do? Come to analysis. Take total of pre-column. 575. Post column total 45. 575 you transfer to goodwill working note, pre-acquisition profit working note 1. And this 45 P Limited NCI. How much is P Limited share? 80%. 80%. NCI 20%. 80% of 45. Is it 36? and 20% of 45, 9. 36 and 9, write in SOCIE, post acquisition profit. 36, 9, 45. So how much is goodwill now? Goodwill is pending. Goodwill before impairment is 1040.5, and after impairment 760.5. Goodwill write down 760.5 in the SOFP. 760.5. And one more task is pending, SOCIE. First, opening balance line total. Individual line total 2000 plus 1400 plus 380. Yes. Issue of share line 360, goodwill 280, post acquisition 45, finance cost 78.76. Now you take total 2200, 160, 1133.14, triple, 3826.14. Is it right? Say yes. Yes. 3826.14. 2200 you write in share capital. What is the total of these two items for writing in other equity? 1293.14. So let us write down in the main page, share capital 2200, other equity how much you said? 1293.14, and NCI. No, just check whether it is telling. 9580 and this one, amazing. Okay. Now write one note, goodwill is adjusted to NCI. Goodwill is adjusted in NCI because NCI is measured at fair value. Because NCI is measured at fair value. This answer is over. Now come to question number 28. Welcome to question number 28. SOFP of P and S as on 30th June 2018 are given below. Non-current asset, land 45002500, plant and equipment 24001750, and then investment 8000 in S column 0. Investment S column 0. Okay. Current asset, inventory, receivable, bank, then ordinary share capital, underline 50 paise. 50 paise means one share is having a face value of 50 paise. So subsidiary, how many shares are there in subsidiary? If the share capital is 1000, so number of share will be 2000. Is it right? Retained earning, NCI, NCL, 8% loan stock, current liabilities. Now understand the adjustment. P acquired 75% of S on 1st July 2015 when the balance in S retained earning was 1150. 1st July 2015 means how many years are over? Almost 3 years are over. Okay. Because the date of SOFP is 30th June 18. And this is pre-acquisition retained earning 1150. P Limited had paid 3,500 for its investment in share capital of S. And how much is investment appearing in the SOFP? 8,000. And out of 8,000, 3,500 is towards shares. And it also says P Limited had invested 60% of S, 8% loan to S. So that is also included in 8,000. This figure is 60% of loan stock of S. Loan stock of S somewhere below is 500. So means 300 you have invested in the loan stock also. But still the total is not matching. So what is the remaining? Other investments. Other investment will appear in your SOFP. 8,000 minus 3,500 minus 300. 4,200? Yes. This will appear in your answer. This will get cancelled against loan, and this will also be used in goodwill calculation. Point number 2. This is understandable. At the reporting date, P Limited recorded a payable to S 400. This did not agree to the corresponding amount in S financial statement of 500. The difference is represented by a cash in transit. So you take your pen, tick mark first investment, then tick mark receivable, tick mark bank also, tick mark current liability also. So what will be the effect? Current liability reduced by 400. Receivable reduced by 500. Bank increased by 100. Cash in transit. Okay. Yes. Now in the third line, I will read the sentence. Check. At the date of acquisition, it was determined that S land carried at a cost of rupees 2,500. Carried at a cost of rupees 2,500 had a fair value of rupees 3,750. Had a fair value of rupees 3,750. S plant was determined to have a fair value of rupees 500 in excess of its carrying amount. So plant we have to increase by 500. And this land we have to increase by how much? 1250. Right? On land there is no depreciation. But on plant we have to provide depreciation also. 500 in excess of its carrying amount and had a remaining life of 5 years. So 500 divided by 5. These values had not been recorded by S into 3 years also, because 3 years are over. So we have to provide depreciation additional 300 rupees. Increase the value of plant by 500, reduce by 300. This will go to pre-acquisition, post, and this will go to pre-acquisition. On land there is no depreciation. Point number 4. The P group uses the fair value method of using the NCI. For this purpose, the subsidiary share price at the date of acquisition should be used. The subsidiary share price at the date of acquisition was 2.20 per share. 2.20 per share. And how many shares were held by NCI multiplied by total number of shares are, as we discussed, 2000. 75% is held by parent. So 25% of 2000, is it 500? 500 shares held by NCI. So the value of these shares on the date of acquisition is 1100 on the date of acquisition. Okay. Goodwill has been impaired by 100. Again same adjustment. Because if goodwill is impaired and fair value method is used, then NCI will also be affected. Required, prepare the consolidated SOFP of the P group on 30th June 2018. Very easy problem. So first, to understand the format that I am going to use, consolidated SOFP. Okay, then consolidated statement of changes in equity, where we'll have share capital, retained earning, NCI total, analysis of profit, calculation of goodwill. Okay, this much is enough in this problem. So can we start now with asset side? Asset side, property, plant and equipment, land. First you write down here, parent company 4500, subsidiary company 2500, then increase in value 3750 minus 2500, increase in value 1250. So final figure is how much? 8250. And you have to give a second effect of this 1250. So come to this analysis of profit. Write fair value adjustment. Under that write land 1250. Come back to SOFP, plant and equipment. Parent company write first 2400. Subsidiary write. How much is subsidiary? 1750. What is the increase in value? 500. Depreciation on increase 500 divide by number of years 5 into number of years completed 3. So what is the answer? Is it 4350? Wait. Second effect also I will write 500 fair value adjustment and 300 depreciation. So write down in working note 1 fair value adjustment, PPE, 500, and then right below additional depreciation on PPE, 300 in bracket. We will come back to main page. Investment, right here, investment, total investment is 8,000. Investment in shares, 3500. Investment in loan, 300. Shares, and this is loan to S. So 4,200. This 3,500 is the cost of investment in shares. So that you write in goodwill working note. Consideration paid, 3,500. And this 300 we will deduct from loan on the liability side. Okay. Current asset now. In current asset we have inventory, no adjustment, total only 3,200 plus 900, 4,100. Trade receivable has an adjustment, 1,400 plus 650 minus intercompany receivable 500. Intercompany receivable is 500. So the answer is 1,550. In cash and cash equivalent, we'll add the transit figure. How much is parent company bank balance? 600 plus 150 plus cash in transit 100. Total, is it 850? $850. Asset side is over. Ordinary share capital 5,000. So this has no adjustment. Write first in this main page also. Write in SOCIE also. Retained earning of the parent 8,300 right here. NCI fair value at the beginning was 1100. 500 into 2.20. Price was 2.20. And now let us also write NCI in goodwill calculation 1100. Share capital of the subsidiary in goodwill working, is it 1000? Is it 1000? And then come to pre and post working analysis of profit. Write retained earning of subsidiary. Read the problem and check what was the pre-acquisition figure. 1150. Adjustment number 1 in the question. 1150. Post acquisition difference between 3150 minus 1150. Is it 2000? Yes or no? Next line. Non-current liability. Come back to main page. In non-current liability, loan stock. Parent company is how much? 4,000. Subsidiary is how much? 500. Out of that, 300 is intergroup company. So minus 300. So what is the net effect? 4,200. Current liability 2800 plus 1300 minus intergroup transaction 400. Is it 400? Say yes. Adjustment number 2. Intercompany payable. Intercompany payable. So how much is the net amount here? 3700. 3700. Adjustment number 1 is over. Adjustment number 2 is over. Adjustment number 3 over. Adjustment number 4 is over. 5. Goodwill has been impaired by rupees 100. That is pending. So come to working note on goodwill. 2 less impairment 100. And this 100 you allocate to parent and NCI. Consolidated statement of changes in equity. Goodwill impairment. Retained earning column 75. NCI column 25. Total column 100. 75%, 25%. All adjustments are over. So now if all adjustments are over, come to this analysis of profit. How much is in the pre-column total? Pre-column 2,900. Post-column total 1,700. P limited only post-column bifurcation. 1,700 into 75%. 1275. NCI 25%. 425. Come to this goodwill calculation. Can you tell me, first you transfer 2900 here. Anybody goodwill 700 minus 100 600. So let us come to asset side. Goodwill 600 in the outer column. Then let us come to SOCIE. Add post acquisition profit. In retained earning column, NCI column, total column. Okay, total of opening balance also 14,400. Okay, total of share capital, retained earning 94. No, try again. 9,500. NCI total 'So share capital 5,000 I think we have written retained earning 9,500, right? NCI is how much? 1,500. Done. Take total of the asset side. 23. And liability side. Same. Amazing. Over. Which is the next question now? Question number 29. SOFP of P Limited and S Limited on 31st March 18 is given below. Rupees in lakhs. PPE investment in S current asset. Inventory other current asset. Equity and liability, share capital, reserve, non-current liability, current liability. P acquired 80% of the shares in S Limited on which date? 31st March 18 only. And what is the SOFP date? 31st March 18 only. Is there any post-acquisition? Prepare consolidated SOFP. So this will require just 2 minutes, okay? First to have the SOFP format, SOCIE format, goodwill format, right? Analysis of profit I am not preparing. Everything is pre. So I can directly write in this goodwill working note only. Okay. So ready, steady, go. PPE total. Alright. Figures in lakhs. Then investment in S. Goodwill. Consideration paid. Is how much? Is it 9? Inventory. Take total. 6 plus 4. Very good. Other current asset. 2 plus 2. 5. 4. Okay. Share capital. 15 right here. And come to SOCIE share capital. Opening 15, retained earning 5. Subsidiary share capital 5 and subsidiary pre-acquisition profit also 5. Is it right? Because all reserves are pre-acquisition reserve. And come back to SOFP. Non-current liability total 3 plus 2. Hanji. Non-current liability total 5. Current liability 4 plus 2 6. Okay. What is not given? NCI. So we'll use this figure proportionate share in net asset. This is 10. So NCI we will take 2. 20% of 10. That is 2. Total this is 11. This is 10. So goodwill is 1. So write goodwill one, and come to SOCI. NCI also write down 2. Total 22. Post acquisition is not there. So write down in the main page retained earning 5. This is 2. Total. How much is the total? This is 33. This is also 33. Done. Good. One more question we will take. Come to question number 3030. Read question number 30. क्या हो गया? Question number 30. On 1st May, underline 1st May 17, K bought 60% of S, paying rupees 76,000 in cash. The summarized SOFP of two company on 30th November 17. So between 1st May 17 and 30th November 17, how many months? In November, May, June, July, August, September, October, November. 7 months. So 7 months post, which means 5 months will be pre. 5:7 current year profit will apportion. Non-current asset, PPE, investment, current asset, inventory, receivable, cash. Share capital, retained earning, non-current liabilities, 8% loan stock, current liabilities. Following information is relevant. The inventory of K includes rupees 8,000 of goods purchased from S at cost plus 25%. So what is the unrealized profit on stock? If it is 25% of cost, it is 25 by 125 of selling price into 8,000. So unrealized profit is 1,600. Tick mark inventory. reduce inventory by 1600. Is it upstream or downstream? Upstream transaction. So this will affect NCI also. Okay. So we will adjust it in the post acquisition profit of subsidiary and then divide the post acquisition profit of subsidiary. Point number 2. On 1st June 17, K transferred an item of plant to S for 15,000. The carrying amount was 10,000. So what is the URP on the plant now? 15,000 minus 10,000, 5,000. Who has transferred to whom? Parent to subsidiary. So reduce it from the parent's profit, 5,000. And the asset had a remaining useful life of 5 years. So that means who has provided the depreciation on this? Subsidiary. So we'll reverse the depreciation on that profit part. Take 5,000 on calculator. Divide by how many years? 5. And how many months in this year from date of transfer to the year ending date? 1st June to 30th November is 6 months. Into 6 by 12. How much? 500 rupees. So 500 rupees reversal of excess depreciation in subsidiaries post acquisition profit. So tick mark plant also. 2 adjustment we will do. Reversal of profit 5,000. Reversal of additional depreciation 500. Okay. Next point number 3. The K group values NCI at fair value. At the date of acquisition, the fair value of the 40% NCI was 50,000. So this will be required for goodwill calculation and SOCIE. An impairment loss of rupees 1,000 is to be charged against goodwill at the year end. So this we will adjust in NCI also. 60-40 ratio, parent and NCI. S Limited earned a profit of rupees 9,000 in the year ended 30th November 17. So you go to the SOFP of S. Retained earning is how much there? Retained earning. Is it 69,000? Out of 69, 9,000 is earned in this year. So what is the balance brought forward from last year? 60,000. That you will write in pre-column. Current year 9,000 we will apportion in the ratio of 5:7. 5:7. Current year 9,000, 5:7. This much care you have to take. Point number next. Loan note in S books represent money borrowed from K on 30th November. So tick mark 8% loan stock in the books of S. Is it 20,000? Cancel that. And go to asset side. Where is the loan stock? It must be hidden in the investment. So tick mark investment minus 20,000. Next line. Included in K receivable rupees 4,000 relating to inventory sold to S during the year. S raised a check of 2,500 and sent it to K on 29th November 17. K did not receive this check until 4th December. Now understand 3 adjustments. 1. Tick mark current liability. Tick mark current asset in receivable and cash. Included in receivable is 4,000. So 4,000 reduced from receivable. How much is the transit amount? Add in cash 2,500. So how much net amount you will adjust in current liability? 1,500. Current liability adjustment will be 4,000 minus 2,500 because that party has issued the check. So they will reduce their liability. but the party who has to receive the check has not received. So they will still show receivable 4,000. So therefore, current liability is 1,500 to be eliminated. Required, prepare the consolidated SOFP. Only one adjustment we have not discussed. What is the outside investment of K? Total investment of K is 98. 76,000 is investment in share. 20,000 is loan to S. So therefore 2,000 is outside investment. 76,000 is given in the first line. Okay. So this 2,000 will still appear in SOFP. This we will cancel. This will write in goodwill calculation. And this will come in SOFP. Okay. So draw the format. CBS is ready. Statement of change in equity is ready. Analysis of profit. Goodwill. That's it. Dear student, start. Property, plant and equipment. First write parent company. How much is that? You want to write rupees in 1,000 or you want to write all digits? Full. That is better. Sometimes it creates confusion. So 1,38,000 parent. Subsidiaries how much? Subsidiaries how much? 1,15,000. What is the unrealized profit on the transfer of plant? Is it 5,000? So that unrealized profit reduce. 15,000 minus 10,000. 15,000 minus 10,000, 5,000. And you add back the depreciation, additional depreciation on 5,000, divide by 5 into 6 by 12. How much is that? 500. Reversal of additional depreciation. 5,000 divided by 10 into 6 by 12. Any answer? 248. 2,48,000. 500. 248, 500. And we have to give the two effect of these two transaction. Who had transferred to whom this plant? K transferred to S. So we'll remove it from K's profit. Where is K's profit? Retained earning. So come to SOCIE. Less unrealized profit on plant. In retained earning column, minus 5,000. And where will you eliminate that reversal of depreciation? Subsidiary. Keep first 4-5 lines blank. Then write down reversal of excess depreciation. 500. 5,000 divided by 10 into 6 by 12. Second effect is over. Post column you have written. Now what about this investment 98,000? Understand, out of 98,000, 76,000 is for purchase of share. 20,000 is loan which we will cancel. And remaining 2,000 will appear as investment. 2,000. Right calculation here also. 98,000 minus 76,000 minus 20,000. Okay, understandable. Next line. Current asset. Inventory. 15,000 plus 17,000. But there is an adjustment number 1. There are some stock of 8,000 which includes profit at cost plus 25% margin. So minus 25 by 125 into 8,000. This is URP, unrealized profit. So give me the final effect first. 37,000? No. This is 15 plus 17, 32 minus 1600, 30,400. Now this is, who has transferred this to whom? Subsidiary to parent, correct? So whose profit should be reduced? Subsidiaries. Come to post column. Subsidiary post column, write down unrealized profit on stock 1700. Sorry, 1600. So automatically it will get bifurcated between parent and NCI. Dear student, continue. Receivable. Read the adjustment below. Adjustment number 7. Included in K receivable is rupees 4,000 relating to inventory sold to us. So 4,000 I will reduce here first. Receivable 19,000 plus 20,000 less 4,000. So how much is that? 35,000. Read the question further below. S raised a check of rupees 2,500 and sent it to K. K did not receive this check until 4 December. So come to cash and cash equivalent. 2,000 plus 0 plus check in transit. Check in transit 2,500. So how much is the total of this? 4,500. Now you come to next line, share capital, parent company 50,000 right here in share capital. Also go to SOCIE, right there, share capital and retained earning, parent company. Opening balance, retained earning. Is it 1,89,000? Parent. And how much is NCI? Check, it is given in the point number 3. Date of acquisition NCI 50,000. 50,000. So the NCI I will write in goodwill working also. 50,000. Total of A plus B here in goodwill working note is how much? 1,26,000. Is it right? Come back to your question. Share capital of subsidiary is 40,000. Right here in goodwill working, share capital 40. And this 69,000 right on the analysis. Right, retained earning. Pre-acquisition write down 60,000. In bracket write 69,000 minus 9,000. And write down next line, current year 9,000. In the ratio 5:7. Current year profit rupees 9,000 apportioned in the ratio of 5:7. How much? 9,3750, then 5250. Okay. So retained earning is over, both companies. Non-current liabilities. 8% loan stock will get cancelled. Don't write. We have cancelled it on the asset side, second effect. Current liabilities. Now here there is an adjustment. 33,000 plus 23,000 minus how much? Write in bracket. 4,000 minus 2,500. So the net effect is, how much is the net effect? 54? 54,500? 33,000 plus 23,000 minus 1,500. Why 1,500? 4,000 one party is showing receivable, and you have already sent a check of 2,500. So you have to pay only 1,500 to the other party. Okay. Balance sheet items are over. Check adjustment number 1 over, 2 over, 3 over, fourth is not over. In fourth they are saying impairment loss of 1,000 is to be charged against goodwill. So go to goodwill calculation, less impairment 1,000. And then since you are measuring NCI at fair value, I am going to distribute the impairment loss on goodwill in the ratio of their shareholding. So write here impairment of goodwill. What is the ratio? 60:40. So 60:40 means 600 parent, 400 NCI. Is it right? Adjustment number 5. S earned a profit of 9,000. Done. 6. Loan note in S books represent money borrowed from K. Done. 7. Included in receivable 4,000, etc. Done. Oh, it is almost over. So can you now close analysis of profit working? How much is the total of pre-acquisition? 63,750. That you transfer to working note number 2 and write here working note number 1 reference. Post column total is how much? 4150. And then you write down here K Limited 60%, NCI 40%. 60% of 4150, 2490, very good. And 40%, 1660. Okay, let us first complete this goodwill working note now. Anybody who calculated how much is the goodwill? 21,000? 22250 minus 1,000. 21250, correct? So what I'll do, I'll go to main page, right here goodwill 21250, working note 2, Okay. And then let us come to statement of changes in equity. Add post acquisition profit. What is parent share retained earning? And NCI share total. Okay. So now complete the lines first. Total of the last column first. 2,89,000 minus 5,000 minus 1,000 positive 4150. Column totals 50,000 185 890. Then, huh? Last column 287 150. Is it right? This I think we have written 50,000. Retained earning write down 185 890. And NCI is how much? 51,260. Total of share capital and other equity in the outer column 235,890. Okay, okay. So what is the total now? 341 341 650. Is it matching? Tallying? Query? Now we'll continue.